Hello, everybody, and welcome back to tracking our local shifting real estate market here in southern New Jersey, Burlington, Camden, Gloucester counties, 900,000 and below. So we are in week 11 of March. We've set one record. Today, we're going to talk a little bit about our stats. I'm going to talk a little bit about interest rates, and then we're going to jump into the 8 most important criteria when you are going to be selecting a rental property. So let's jump into our stats for this week. We have been hovering total active listings around this kind of mid to high 1,200 active listings for the 3 counties. So I guess if anything to say, there's been a decent replenishment of the listings that have been coming off. Now, last week we saw that we had really tanked in our days on market. And if I just slide this over a little bit, again, just to reiterate, our days on market were 72 and 44, average and median, and we're all the way down last week to 59 and 23. Now, pretty similar this week, 59 and 25, but again, just proving the point that we are moving quickly, right? So the speed of the market is definitely there. I always recommend your 3-day rule when you are out shopping as a buyer. 3 days to know about it. That's why we use the MLS for our search, to be able to put eyes on it, either in person or let me get a virtual tour done, and 3, offer on it. If you do not do those 3 things in the first 3 days, the likelihood you'll be able to offer on a property drops 90%. So that's the rule. That's the process we use, and it has been working. But in this market, you do have to have a little bit of speed. So you need somebody who's doing this actively. What I liked to see a lot was another week where we were over 300 for our new listings. And in a really odd, just coincidence, we had exactly the same amount of properties that were listed that went under contract. I did check throughout the entire year since the start of 2023. That has never happened once. I mean, it is very coincidental. I don't think there's much to be taken from it other than just a funny coincidence. But what I do like to see is that our new listings that are pending was much higher than our closed. So that means, again, we have a lot more listings coming to the market, a lot more that are just getting under contract, and it's outpacing that closed number. So it's still keeping our active listing number in that mid to high 1200s. So that's all well and good. Expired, we were right in the middle of our month, so expired, withdrawn, and canceled. Again, we're going to expect to see those low. Really, beginning of each month, you're going to see that a little bit higher, especially as it's kind of you're taking in the last day of the month, those sort of things. This was an interesting one, though. For price reductions, we actually had the most price reductions. My face is kind of in the way here. We had the most price reductions this week than any other time in the year. It wasn't by a ton. 2 weeks ago, we were at 122. We were back in 127 the second week of the year. So I don't know what's statistically significant we want to take from that. There's not a lot that this may have just been more of a coincidence number here. More of a coincidence number. I don't really see a lot of the metrics that would have pushed that for any specific reason. The one thing I will say is that our median list price did come back down a little bit off the ledge. And we were up there sitting at 349 for 2 weeks. We were nervous if it was going to eclipse over 350, but kind of came back down to earth here a little bit at that $340,000 mark. And maybe those price reductions had something to do with that, having that kind of factored in there. Okay, so that's stats for this week. All still kind of right in line with what we like. We want more new listings, not as many quite closing, and hopefully the days on market doesn't drop too much further, or else it's going to be kind of feeding frenzy. Now, I'm going to slide my face over here a little bit. Now, I want to talk interest rates because we were promised at the beginning of the year, end of last year, that 2024 is going to see a number of interest rate drops. Now, I can go into all the kind of the wording from the Fed and from the chairman and all the different things, but that's boring. So let's just do some high-level highlights. They aren't coming down as quickly as they thought they were going to. Do I think that the election year has something to do with it? Probably. Unfortunately, they are connected as much as I don't want them to be connected, but they are. So let's just take a look at what has happened. So again, this is data that I pull from Freddie Mac. You can go and you can pull all the same data that I'm pulling from. I just organize it in a chart and present it to you. So this was sort of our rise up last year, right? And we remember back here right at the end of October, just a week before Halloween, we had maxed out. And the rate that I'm taking here is your 30-year FRM, or fixed rate mortgage number. That's the number we take. And so they were at 7.79% back at the end of October of last year. Now, luckily, through the winter, through November, through December, and then turning into the first of the year, they had come down over 1.2 points or 1.1 points down to 6.62%. So that was a great drop to see there. And I think that kind of helped spur us through that slow end of the year, the December kind of slow January. Our numbers were down, but the interest rates did help to kind of keep some buyers in the game as they were coming down. But then as you can see here, we're sitting here looking into this little tail where, okay, well, they were down there for a little bit. And then in February, we actually saw them come up. And now we're sitting here in the first week of March, and we're at 6.88% as of the last time that we had our FRM stat pulled. So 6.88%, obviously a lot better than where we were, but still 6.88% that's not enough to move the needle for you sellers that are still staying in your house because you're waiting for the interest rates to become a more favorable one to swap out of from the one you have. You're maybe one of the 2.75%, 3.5%, 4.5%, even low 5%, and you're still keeping an eye on this number, waiting for it to start to reverse course a little bit. I am too. We were going to be doing a refinance, and I'm actively waiting for the interest rates to continue to come down a little bit more before we think that makes financial sense. So just wanted to give you that quick update on where we're sitting with interest rates at the moment, 6.88%. I would like, again, they're kind of trickling up a little bit, but we want to see that go back down. We want to see that start to fall, similar to the rise that we had here in the middle part of last year, and that should equate to more homes sold and more listings coming on the market. That's the kicker, is that these interest rates, while they're great for the first-time buyers kind of don't really care that much about the interest rate because they don't have anything to compare it to. If you're sitting on equity and you own a home, you do have something to compare it to. And that's a much harder conversation to jump into this market than just a low interest rate or non-interest rate or a high interest rate. Okay, let's jump, because I recognize this. We're doing all this predicting and saying that, hey, in 2024, we expect to see prices on the rise. We expect to see interest rates come down. And a lot of you are sitting on more equity than you kind of know what to do with. So the plan that my family has is we're going to be going head on into cash flowing investment properties and rental properties probably for the next 15 years. Now, we have a very long-term sense. I call it get rich slow. Which basically is I'm not looking for immediate heavy cash flow up front. What I'm looking to is invest in a bunch of assets and then ride kind of an appreciation wave up with them, have the ability to refinance some of those properties, lump refinance those properties, and then be able to purchase more properties with the equity. So you have a single family home, and you're sitting on equity, maybe more than you would know, because you said, well, I bought my home at $300,000 3 years ago and I still owe $200,000 on my mortgage. So I have $100,000 in equity, right? Well, no, not necessarily. When you go to if you were to do a refinance or a cash out refinance, they would appraise your property today. That $300,000 home 3 years ago might be worth $360,000, $380,000, $390,000 today. So you're not just sitting on $100,000 in equity, you're sitting on $190,000 worth of equity. You can borrow against that with a home equity line of credit, or do a cash out refinance and truly refinance the property, and then use that cash in order to buy another property and get it set up for a rental. So if we're going to consider those options for generating wealth and for cash flow using an asset that we already have that doesn't take into account any extra income that I have to get from another source, let's go into my 8 most important criteria when buying a rental property. So these are, the descriptions here are basic, right? They're basic. And I try to do that for the purpose of the video. I want to just make it simple and straightforward to read if you're going to be reading, as opposed to kind of visually and auditorily listening. So let's talk about these, but I kind of want to give my spin on each of these. I don't think it's all that helpful for you to just read 8 things that you could research on the internet. I want to give you my spin and bring it into kind of a South Jersey context. Let's start with the most golden rule of all real estate: location, location, location. It is very true in rental markets. But here's what I want you to consider. You have an expectation of what is good or bad from a location standpoint. Renters sometimes have similar criteria. A lot of times, their criteria for location is not nearly as important as what you may bring to the table. Remember, while you always want to buy a property and say, would I live here? That's such an important one, because you don't want to buy a piece of junk, be like, well, I'd never live there. Well, nobody else wants to live there either, if you really wouldn't even live there yourself. So you want to find a middle ground here, but don't bring the expectation of where you would have your single family home for the next 15 years. Don't bring that exact same set of criteria when you're looking at a location for a rental property. There's a property not far from us that we were considering buying, but it's right on the corner of where a Dunkin' Donuts is across the street. It's on the corner where a traffic light is, and there's a high school across the street. Now, a lot of people would probably look at that and say, I don't think I would want to buy as my home there because it's on a little bit of a busier street and it's next to a school. Someone may want to rent just for the years that their kid is in high school so that the kid has the ability to walk to school and they got a Dunkin' across the street that they can walk to and grab their coffee in the morning. From a rental standpoint, that actually might be attractive. So all I'll say with location and here, Paramount, look for properties in desirable neighborhoods with low crime rates, good schools, proximity to amenities like public transportation, shopping centers, parks, and employment opportunities. While all that is true, I don't think necessarily a rental in the middle of Shamong or Tabernacle, just on the middle of a huge farm, is going to have the most amount of people applying for it. You may be able to get specialty tenants for that one, but generally being near the transit opportunities, being near jobs and kind of 295, Route 38, Route 70, 42, 55, 38, all those roads and having at least a general access would be good. Number two, the rental market itself. Evaluate the demand for rental properties in the area. Research vacancy rates, rental prices, trends in the local rental market to ensure there's sufficient demand to keep the property consistently occupied. Now, luckily, here in New Jersey, our rental market is very strong. It's hard to keep a property vacant for long if you price it correctly, and we'll get into this one in a second, the property condition is right. Luckily, in our area, most places are going to rent if you put a fair market rental value on them and they're in good shape. New Jersey is one of those areas for that where we actually do have a really strong rental market. It's quite competitive too. I mean, when we go to help people with trying to apply for a property, I mean, unless you're a golden tenant, meaning you have great credit, you have good income and a low debt to income ratio, and you're not coming with a lot of baggage, previous foreclosures, bankruptcies, pets, all sorts of things like that, you're going to be looked at highly. But we see a lot of people end up not moving forward with the rental search and staying in a less than optimal situation because they can't even compete in the rental market here. So I like the Jersey rental market for the fact that most of the people have to be really darn well qualified in order to even apply for some of the places here. Let's talk property condition for a second. If you are more experienced with the home renovation, home buying, inspections, all of the contractor part of it, your cash flow opportunity will be higher if you find something that does need a little bit of work. You can do something called a BRRRR method, and look this up. It's BRRRR, whatever. But it's basically buy. You would buy it a little bit more outright or using maybe renovation financing. You're going to renovate it, you're going to rent it, and then you're going to refinance it. And what you're able to do is, since you've renovated, you've improved the quality of the property. Now that you've put a renter in it, now you have cash flow in the property. So you're able to refinance that at better terms and pull actually a lot of money back out of the house and then continue to use that money to buy more properties. It's the way of taking the same lump sum and then using that to consistently buy more properties. So again, BRRRR. I might do a video on that at some point, but you can look that up. It's a bigger pockets method. But if you are not, and I just want to finish the second half of this, if you're not overly great with that stuff, you may want to consider buying something that's already fairly finished and fairly done and complete. And maybe all you have to do is put in some new flooring and maybe paint the place. So your cash flow opportunity will be lower because you're probably buying at a slightly higher price point. And there's not as much margin there. But if you're not one for the trades, this would be a little bit easier plug and play rental option as opposed to kind of spending maybe 45 days to 2 months updating a property before you start getting that cash flow. And let's bring it to cash flow potential, right? So calculate the potential rental income relative to expenses such as mortgage payments, property taxes, insurance, maintenance, property management fees, vacancies. Ensure the property generates positive cash flow after all expenses are accounted for. This is the number one mistake people make when they go to buy a rental property. Just buying a home doesn't mean you're going to cash flow positive from it. There are a number of free rental property spreadsheets, and I have a couple of them. If you want to reach out to me, I'm happy to share with you one of my rental property sort of checking. You're just checking. You're checking the P&L of what that's going to do, the profit and loss statement for what that's going to do. Is it going to generate the positive cash flow based on my financing, based on all the other things that you have here? Am I going to be generating $100 a month, $700 a month, negative $400 a month? Obviously, something you're going to want to check before you do it. And I think that's one of the big things that a lot of people turn them off around rental investing. Now, I have a mathematics background. I did finance. I taught statistics in college, and I mean, you see me actively doing an economic spreadsheet every week. So I actually like looking through the numbers and trying to do this stuff. But I understand that a lot of people don't. And when people think about, oh, am I going to buy a rental property? The idea of like, I buy a home and I let somebody stay that and they pay me, that's not complicated. What is complicated is all the insurance and all the fees and the different things that go into it and landlord registration and all the different things that can check up that way. So that might be a big hang up, but I can help you with that. And I have some spreadsheets to help you analyze that stuff anyway. So don't make that such a big hurdle to you getting into real estate investing. Let's talk about appreciation potential. This is the one that I'm kind of banking on a little bit. Now, this is mildly speculative, but consider the potential for property appreciation over time. Look for properties in areas with growing property values or undergoing revitalization. So for me with this, the revitalization part is a little bit tricky because there's not a ton of areas especially in southern New Jersey, that are these up and coming areas. Most of them are fairly established. Now, you have some areas, maybe like Glassboro, where Rowan had put a ton of money into its campus and they're really making that better. And it's starting to have a better attraction for jobs and businesses and funding and things like that coming into that area. That may be one of those areas that has a little bit of fringe, but you're also dealing with like a college rental market. So there can be a little bit more highs and lows, a little bit more risk involved. But the bank for me is this. In any 10-year period in the course of history since we've been tracking real estate, we've never had it go down over any 10-year period. Now, in 2-year periods, 4-year periods, 5-year periods, yes, we have 100% see real estate go down. But even through the Great Depression, Great Recession, we have still seen over a 10-year period that homes do appreciate. So my banking is I'm actually going to put less importance on the early cash flow of some of the first couple properties I get, because once I can get into 1, 2, or 3 or 4 properties, that rising tide is going to raise all ships. And now I'm not just appreciating one property, I have multiple that are all appreciating. So even if they only appreciate by 3%, I get 3% here, 3% here, 3%, 3% here. And as you volume that up together, that's actually a good amount of appreciation. And as I go forward, I can borrow against that appreciation and fund it for more properties. So to me, I'm going to go a little less important on heavy cash flow. Now, it's also be positive, but I'm going to go less importance on cash flow early on, and I'm going to put a little bit more stock, especially in the early part of a 15-year investment period, where appreciation is going to be more, getting in, kind of spreading wide across multiple, and then letting that all rise up, and you'll have a little bit more momentum as you go into it. Financing options. Okay. Explore financing options and consider factors such as interest rates, down payment requirements, and loan terms. Determine whether your investment aligns with your financial goals and risk tolerance. While when you're buying a single family home, get 1 or 2 lenders to kind of chalk up some, pit them against each other a little bit. You'll probably get some good terms. When it comes to financing, I would recommend reaching out to maybe 10 to 15 to 20 lenders. And I'm not kidding. I love my lenders, the ones that I've used. If you've worked with me, you've probably used 1 or 2 of them. And I would absolutely use them if they have the best terms for my investment portfolio. However, investments are very different from a single family home. Depending on how many other properties you have, other investments you have, just your business acumen, you'll be able to get this a little bit better or a little bit worse. So I do recommend from a financing option, you should be talking to like 10 to 20 lenders. Sometimes banks can be a little bit better for investment stuff than a traditional mortgage broker, but that is something I would explore with heavy scrutiny and a lot of options. Do not limit yourself to 1, 2, or 3. Go for like 10 to 20, maybe even more lenders who can give you the best terms possible. All right, and our last 2 here, legal and regulatory considerations. Familiarize yourself with local landlord-tenant laws, zoning regulations, building codes, and licensing requirements. Ensure compliance with all legal and regulatory obligations to avoid potential liabilities and disputes. This whole one can be chalked up to get an attorney, get an attorney, get an attorney. Now, you can go through a lot of this stuff yourself, but before you go to buy a property, you may want to consider, would it make sense for me to form an LLC and buy this property in the LLC? Does it make sense for me to start a trust and then be able to purchase properties as an executor of my trust account? There are tax reasons to do this. There are, potential legal situations to avoid this where they could come after your personal wealth as opposed to just over the LLC and the property's value. So this is a big one. And also, when you go to sign a lease with a tenant, there is a standard New Jersey lease that you can use. However, what I have found is that a lot of experienced portfolio investors, especially if you have multiple rental properties, they want to have their own addendum and rider with a few other particulars about how they want to handle certain issues if they were to arise. Things like, what the tenant would be responsible for if certain things break, if there's some method for communication, payment schedules, penalty fees, all that stuff. You don't want to leave anything to a handshake agreement. Nothing. I don't care if you're renting to your mom. You still want to have everything in writing. You don't ever want to go back on your word when money's involved. And you don't want to go back on your tenant's word when money's involved. Make it black and white, make it clear, make it obvious. Okay. And then here's the last one, your property management. So I, as a licensed agent for 9 years in real estate, having done rental properties, having been involved with rental properties, and having understood them from that perspective, I feel I would likely do a pretty good job being a property manager for a couple properties, maybe 2 or 3 homes. Even at that, I'm still considering, even for the first ones, it might make sense to just get a property manager involved right away, and that they can handle those late night phone calls, handle some early billing and processing, be able to kind of learn through an already established property management system what they do. And I can take things I like or don't like, so that as I go to grow bigger or things like that, maybe even begin my own property management company, I'll have some ideas of what to do here. But decide whether you'll manage the property yourself or hire a property management company. Evaluate the costs and benefits of each option and ensure the property can be effectively managed to maintain its value and attract tenants. A property management company will add some barriers to entry for tenants because a lot of times they want to do their own evaluation, they have their own application fees. So it can potentially reduce the pool of possible tenants for you, but it will make your life easier. It'll also cost money. Generally, it's a certain percentage of what the monthly rental amount is. And obviously, as you're going into the cash flow potential, you need to factor in, okay, am I going to use a property management manager on this? And if I am, how much will that reduce my cash flow? If I don't, what risks am I taking on? But how will that improve my cash flow? So again, guys, this is a fairly basic list. But what I want you to start thinking about is if we're in this market and you're not quite ready to move yourself, but you're sitting on all that equity, let's put it to work building wealth and building foundational wealth for generations to come. So let me know if you have any questions on this. Again, I've made it very public to almost anybody I talk to. I'm 30. I just turned 33. My goal is within the next 12 to 15 years, I'm looking to pick up 100 properties, 100 doors. So whether that come in the form of single family homes, duplexes, quadplexes, multifamily, 10 unit, 12 unit, 15 unit, whatever they end up being, wherever they end up being, that is the only goal I have. And everything I do as a realtor is to help fund my family and to help fund this. So again, generational wealth and cash flow for years to come. Have a great week, everybody. I will see you next week.